In today's rapidly evolving financial landscape, technology is reshaping how we borrow, lend, and fund ideas. Peer-to-peer lending, crowdfunding, and innovative small business financing methods are breaking traditional barriers, creating a more inclusive and efficient financial ecosystem. Let's dive into these transformative concepts and see how they're revolutionizing the world of finance. Segment 1. Peer-to-peer lending, P2P lending. Peer-to-peer lending, or P2P lending, has redefined borrowing by cutting out the middleman, traditional banks. Instead, it connects borrowers directly with lenders through online platforms. Borrowers benefit from lower interest rates, while lenders often see higher returns compared to traditional savings accounts or investments. This system emerged with the rise of the internet, which made direct communication between borrowers and lenders possible. Platforms use algorithms to assess borrowers' creditworthiness and calculate interest rates. Lenders, on the other hand, can diversify their investments across multiple loans, managing risk more effectively. But what drove the rise of P2P lending? The 2008 financial crisis played a key role. It eroded trust in traditional banks, pushing individuals to seek alternatives. Meanwhile, low savings account interest rates made P2P lending attractive for investors looking for better returns. And for borrowers, especially those with imperfect credit histories, P2P platforms provided access to loans that traditional banks often declined. While P2P lending isn't without risks, such as the lack of government insurance and potential borrower defaults, its future remains bright. As regulatory frameworks evolve and platforms improve their risk management capabilities, we can expect P2P lending to play an even bigger role in democratizing finance. Segment 2. Crowdfunding, the power of the crowd. Next, let's talk about crowdfunding, an incredible tool that brings people together to support projects, businesses, or causes. Crowdfunding allows individuals to raise capital from a large group of backers, bypassing traditional financing methods. It's not just about funding, it's about building a community. There are three main types of crowdfunding: reward-based, equity-based, and donation-based. Reward-based crowdfunding. Platforms like Kickstarter and Indiegogo let backers pledge money in exchange for products or perks. For example, the Pebble smartwatch campaign raised over $10 million, proving demand for their product before it hit the market. Equity-based crowdfunding. This model allows people to invest in a company in exchange for ownership. Take Brewdog's Equity for Punks campaign. It not only raised significant funds, but also turned loyal customers into shareholders. Donation-based crowdfunding. This is all about philanthropy. Platforms like GoFundMe enable people to support causes they care about without expecting anything in return. But it's not always smooth sailing. Crowdfunding success depends on creating a compelling campaign, managing backer expectations, and delivering on promises. However, its potential to drive innovation and entrepreneurship is unmatched, especially as digital platforms evolve and new technologies like blockchain enhance transparency and security. Segment 3. Small business financing in the digital age. Finally, let's explore how small businesses are leveraging technology to secure funding in a competitive market. Traditionally, small businesses relied on bank loans or personal savings, but these often came with strict requirements or high costs. Today, alternative financing methods are providing new opportunities. Online lending platforms, for instance, have revolutionized small business financing. These platforms use advanced algorithms to assess creditworthiness based on real-time data, offering quicker approvals and tailored loan terms. For businesses with limited credit history, this flexibility can be a game changer. Then there's crowdfunding, allowing businesses to raise funds directly from consumers. By pre-selling products or offering special perks, companies not only secure capital but also validate market demand. Peer-to-peer lending adds another dimension, connecting businesses with individual investors for loans at competitive rates. For businesses facing cash flow issues, invoice financing offers a lifeline. This method lets companies borrow against the value of their unpaid invoices, providing immediate funds to maintain operations. Yet these innovations come with challenges. The variety of options can be overwhelming, and some alternative financing methods carry higher costs. Additionally, navigating regulatory complexities requires careful attention to compliance. Segment 4. Risks and rewards of peer-to-peer investing. One of the biggest attractions of P2P investing is higher potential returns. Unlike traditional savings accounts or bonds, P2P loans often come with higher interest rates. These reflect the greater risks but can significantly enhance your yield, especially in low-interest environments. There's also a social impact element. By lending directly to individuals or small businesses, investors can help fund life goals. Whether it's launching a startup, consolidating debt, or pursuing higher education, it's an investment with a purpose. Another key advantage is diversification. P2P platforms allow investors to spread their funds across multiple loans, each with varying risk levels and terms. This helps mitigate potential losses while tapping into a range of investment opportunities. But as with any investment, P2P lending comes with its risks. The primary concern is default risk. Most P2P loans are unsecured, meaning there's no collateral. If a borrower fails to repay, recovering your money can be challenging. While platforms categorize loans based on risk, the potential for loss remains. Another challenge is limited liquidity. Unlike stocks or bonds, P2P loans are not easily sold off. You're often tied to the loan's full term, which could range from months to years. Some platforms offer secondary markets, but selling loans early may incur losses. Lastly, regulatory uncertainty could pose risks. The P2P lending industry is still maturing, and changes in regulation could impact returns or the way platforms operate. So, how do you balance these risks and rewards? The answer lies in diversification, research, and risk assessment. Spread your investments across different loans, research platforms thoroughly, and choose loans that align with your risk tolerance. P2P investing can be a powerful addition to your portfolio, but a strategic approach is key. Segment 5. Navigating regulatory challenges. As markets evolve, so does the regulatory landscape, and navigating these changes is one of the biggest hurdles for businesses today. Let's unpack why regulations are both a challenge and an opportunity. One major factor is the pace of technological innovation. Fields like finance and healthcare often outpace existing laws, leaving businesses in a gray area. Companies must interpret outdated rules or risk non-compliance, a daunting task in dynamic industries. For global businesses, the challenge multiplies with regional regulatory diversity. Each country has unique rules governing taxes, data privacy, and environmental standards. Staying compliant across jurisdictions requires immense resources and adaptability. Consider the example of the GDPR in the European Union. When introduced, it demanded sweeping changes to data privacy practices worldwide, forcing businesses to revamp operations at significant costs. Environmental regulations are also gaining momentum. Governments now require businesses to adopt sustainable practices, often necessitating heavy investments in green technologies. In the financial sector, stricter post-2008 regulations demand robust risk management. While these rules protect consumers, non-compliance can result in hefty fines and reputational damage. How can businesses adapt? RegTech, or regulatory technology, is emerging as a solution. By automating compliance tracking and reporting, companies can stay ahead of regulatory changes. However, technology alone isn't enough. Legal expertise and a culture of compliance are equally critical. The bottom line, businesses that embrace compliance as an opportunity to build trust and sustainability will not only survive, but thrive in today's complex regulatory environment. Segment 6. The future of decentralized finance, DeFi. Now let's turn to one of the most exciting developments in finance, decentralized finance, or DeFi. DeFi eliminates intermediaries like banks, enabling peer-to-peer transactions through blockchain technology. This isn't just a new way to manage money, it's a paradigm shift. What does the future hold for DeFi? First, we'll see expanded services. Today, DeFi offers lending, borrowing, and trading. Tomorrow, it could include decentralized derivatives and prediction markets, all powered by smart contracts. Self-executing agreements coded directly into blockchain systems. Next, expect greater integration with traditional finance. While DeFi won't replace banks entirely, it could complement them. For instance, banks may use blockchain for settlement processes, blending traditional stability with DeFi's efficiency. Perhaps the most transformative impact will be on financial inclusion. DeFi can provide banking services to millions of unbanked people worldwide. All you need is an internet connection, making financial tools accessible to remote or underserved regions. However, challenges remain. DeFi must tackle scalability and usability. High transaction costs and network congestion on current blockchain systems hinder growth. Innovations like scalable protocols and user-friendly interfaces are critical to bringing DeFi to the masses. And of course, there's the issue of regulation. Operating largely unregulated, DeFi faces scrutiny from governments aiming to protect consumers. Striking a balance between innovation and oversight will be crucial. Despite these hurdles, DeFi's potential is immense. By breaking down barriers and democratizing finance, it offers a future where financial services are accessible, efficient, and directly controlled by users. From the opportunities and risks of P2P investing to navigating regulations and embracing the promise of decentralized finance, we're witnessing a transformation in how we think about and manage money. These shifts aren't just reshaping financial systems. They're creating new possibilities for individuals, businesses, and entire economies. Thank you for joining us on this journey through modern finance.